Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. And on today's show, we welcome Michael Guide, who is the author and publisher of the Lead Lag Report. How are you today, Michael?
I'm good. How are you doing?
Very well, thank you. Towards the end of last year, you wrote a very interesting article, which was called Fearing the Fearless Stock Market. And you wrote about the continued rise of the stock market and compared it to how undervalued commodities were as a group. And since then, the general markets have only climbed even higher. So what are your views on commodities today, especially gold?
Yeah, so look, I mean, it's important when people talk about markets and them reaching new highs to define which markets, right? I think in the United States, at least, most people, when they think about the market, they think purely about the S&P 500 and the Dow because that's what they're constantly seeing on TV. That's what they're seeing in articles, when in reality, not all markets are the same and not all markets have made new highs. Just as a sort of some background info, right? Small caps are not at new highs. Emerging markets certainly are not at new highs. Europe has been improving, but it's nothing truly remarkable, at least relative to U.S. markets. So you've had markets at new highs, but I always like to tell people, well, which markets are we talking about? That's sort of number one. Number two, I've been very public in the last couple of months or so that I think you're at a stage in the cycle here where the Federal Reserve and central banks in general, but especially the Fed, is recognizing they really do have to try to jam up inflation expectations. They really do have to do everything possible to let this run hot, to inflate away all of this debt that's pervasive throughout the globe and really on the government balance sheet side. And one of the things that can help the Fed to let it run hot and to increase inflation expectations is something that's not really in their control. It's commodity prices. Generally, when you see commodity prices rising, that's a form of cost push inflation. In other words, you will see as raw material prices increase, some of that gets passed down to the end consumer. And given that commodities have been in this prolonged relative bear market for some time, it's been left for dead. And generally, when you have an asset class that's left for dead, it tends to make a comeback, so similar to Lazarus, right? Coming back from the dead. So if you believe that likely you're going to have some kind of reflationary repricing going on, that means weak U.S. dollar, that means higher yields for bonds, and that means commodities probably are a big component of that trade. That may be why you're seeing a lot of the industrial commodities show some strength. I know we're going to be talking about that a little bit later in the show, but silver certainly has been looking pretty good. And gold is one of those parts of the commodity landscape which kind of marches to its own beat, but I think is also reflective of maybe some concerns over reflationary positioning and hedging for a more volatile period ahead. Gold has been in a bit of a bear market for a long time, and has come back nicely. I think that's going to continue. Gold miners are a little bit trickier in that trade purely because it's not as strong of a correlation to gold prices as one might normally think. But I think the broader point is that yes, markets are at new highs, but at some point the things which have been at lows for a long time will start gaining momentum, take attention and dollars away from U.S. equities, and probably start their own secular bull move.
Well, let's talk a little bit about some of the indicators you like to use when analyzing the markets. And you mentioned the gold price and how for the last few years, at least, it's been in a bear market. So when you look at a chart, do you look at a multi-year chart with perhaps a few moving averages to give you a clearer picture on the market? Or is there something more complicated that you look at which might help you?
Yeah, it's interesting talking about technical indicators in general, and if they're helpful for certain asset classes or helpful for trading, right? Most people look at things like moving averages as indicators of trend. In reality, they're indicators of risk. I've written extensively when you actually backtest moving averages. Moving averages don't tell you much about an uptrend; they tell you about volatility. What matters for moving averages is a price underneath, not really above, in terms of future price movement. So when I look at gold, I think it's one of those things where, we know gold has outperformed, most markets since 2000, but not obviously in the last decade or so. And these things go through cycles. For something that has done well for a long period of time, that tends to have a period going forward where it doesn't do as well, and vice versa. As I was actively on the road and presenting to CFA chapters here in the States, I would always joke that the one thing you can always rely on in markets is mean reversion, and that mean reversion is a concept as old as the Bible. He who is first shall be last, and last first is a form of mean reversion. And sometimes it's as simple as that when you're looking at investment decision making. The thing which has done the best for the last several years may not do the best going forward. The thing which has not done the best or even done the worst for the last several years may suddenly become the best performer. So I think there is a mean reversion cycle trade. I don't know if it's something you can necessarily follow exact indicators on for gold, but I just think that you're at a point in time where it makes sense to go into underinvested areas and into things really which are not correlated. Keep in mind, gold really is a non-correlated asset. It doesn't really move to stocks, doesn't really move to bonds. It's kind of its own animal. And from an asset allocation perspective, if you're concerned about what's going to happen to your investments going forward, you want more diversification, which means you want more non-correlated assets, and gold absolutely fits the bill in that case.
Yeah, and you recently tweeted about palladium, which, as we both know, has been a very good performing asset over the last year at least. In your tweet, you suggested that it generated almost 2.5 times the return than generated by gold. So after such a big run up, what's next for palladium in your view? From a big picture perspective, is the price going to consolidate for a while, or is this the end of its bull market? And what has driven the price rise from your perspective? Is it purely fundamentals that have now taken over?
Yeah, I've read a lot of interesting things about it. It seems that there is in general, supply shortage that's happened, in that part of the landscape, and palladium's used a lot in automobiles. I think that so there's a couple of truisms, right? One is that at least when it comes to commodities, the cure to high price is high price. In other words, as prices rise substantially for a commodity, suddenly, the marginal producers start creating more activity to release more of that commodity into the marketplace because now it's more profitable at a higher price. That increases supply. That doesn't necessarily mean that the bull market, though, is over. It probably just means that the rate and acceleration is going to start to slow down. Keep in mind, it's not just palladium. When you look at there's other commodities which relate to automobiles and pollution. I think it's rhodium is the one. Has also had a fairly big move, and anything that's industrial commodity wise has also had a nice run. Silver, in particular, I think these are early moves. Again, these commodities have done nothing for such a long time, and I think people are always trigger happy once something has had a big move, out of nowhere to just take your profits and run. The reality is, oftentimes, when you're in an area which hasn't done anything for a long time, the initial phases of a new uptrend tends to be very violent, and then drift continues. I think that's more likely to be the case. When you look at any commodity that's industrial related, palladium obviously, and platinum too, among those.
Yeah, some great points there. Okay, let's talk a little bit about your history. I noticed in your bio you mentioned your father and his influence on how you started trading. So talk to us about your early experience in the markets. I understand your father did a lot of technical analysis while working at Merrill Lynch in the late 1980s. Can you talk a bit about that?
Yes, I mean, I kind of grew up in the industry to some extent. So my father worked on Bob Farrell's team in the late 1980s. Anybody that's an old hand in the industry will recognize the name Bob Farrell, sort of a legend at the time in terms of technical analysis. You can Google, Farrell's 10 rules, which are often referenced by a lot of people as far as, things to consider when investing. So Les was with Merrill Lynch, worked alongside him, started his own investment firm, my father, in 91. Grew that firm to about $1 billion in assets up until the tech bubble. Started up his own hedge fund, was aggressively shorting tech stocks and did quite well, for himself in that hedge fund strategy. But the industry had changed over time. When my father was first getting involved, it was not as quote unquote style based or box based in terms of you being in a particular category or asset class. And I think that any of the real old school money managers, they don't try to focus on specific style. They're focused on just making money. But as things became more and more rigid and institutionalized, it became harder and harder for the old school money managers, again, like my father, to sort of really gain traction among the holders of capital, the consultants, the institutions. So his firm shut down in '08, when it's around the time when he passed. And in terms of sort of my own exposure and experience, there's nothing quite like being home every night and hearing your father, your mother talking about the markets while I'm simply trying to, pull out my Game Boy and play something to not listen to it. So, I like to tell people it's sort of one of those things where, being exposed to something, you always get osmosis. You're always inhaling and getting some information that, whether you realize it or not, is in your subconscious, and that does, I think, form your viewpoints on the world. My father wrote 2 books on markets, one of which I republished, called Intermarket Analysis and Investing. That book was not a major bestseller in 1990, 91, but as I've republished it and myself being more in the media, more and more people have been paying attention to that book, which, coming up on 30 years old, yet still very relevant to today's markets, despite all of the central bank intervention that we're seeing.
And has the way you've analyzed the markets, has that changed throughout your career so far? And what's the best piece of advice you've received when trying to make money in the markets?
It's I think this is a very tough question to answer when you have hindsight. So arguably the last 10 years or so, and really I think ever since QE3 in 2013, any form of analysis, any form of your basis for why investments should do what they do has largely gotten destroyed, right? Because what's happened is that central banks have made it purely about beta, purely about just broad passive indexing, buy and hold, no risk, no volatility. Any volatility that lasts for a split second, and then markets come right back. That analyzing markets in today's world is almost an exercise in futility, because you basically just are fighting against a tremendous flow of liquidity. And that makes everything co-move in the same way. If everything co-moves in the same way, you can't really generate alpha. This is a story that's not just unique to analysts or traders and PMs like me. It's something that is pervasive in the industry. Hedge funds know this left and right, given just how poor performance has been and how much it's really been just pure beta market-driven movements. Now, it could very well be that is a permanent change, that this time is different, in which case we should all be looking for new careers. Or it could be that this is just one of those very abnormal cycles that has lasted longer than people thought it would, and that you're going to see a return towards dispersion in assets, dispersion in investments, and a cycle where all of the knowledge you may have accumulated testing and looking at markets historically suddenly has value. I certainly hope that that's the case. So so that's a long-winded way of basically saying not much has changed in terms of my viewpoint on how to analyze markets. The only thing that's really changed is my patience, in the sense that I recognize I can't chase this current cycle as somebody who's tactical, somebody who's active, somebody who knows a lot of the research behind why asset classes do what they do. I have to wait for the cycle to come to me. And I think as I talk to advisors and I talk to investors, I think the thing that I try to emphasize the most to people is sometimes survival is winning. Sometimes trying to be ambitious and trying to chase what's working, it might work in the moment, but the reality is it's going to hurt you longer term. So a lot of this game of investing, when you really believe in your indicators and have thoroughly tested them and know know what you know, you can't fight what's happening in the current moment. You can try to join it, but importantly, you can't also forget what you know. And that means that you've got to really just sort of sometimes wait out cycles that don't favor your approach to investing. As long as, I know there's a large amount of the audience out there in general in this business that tends to be bearish, that says, how could it be that, markets have done what they've done when, all this is propped by central bank intervention. I sympathize with that view because I'm in the same viewpoint. You can still make money being wrong as long as you're not short in these types of cycles. But, don't throw in the towel in terms of what your beliefs are as long as it's based on something real.
Yeah, some very interesting points there. I think probably waiting for the cycle is perhaps one of the hardest things for investors out there.
Absolutely.
Yeah. Okay. You mentioned your father's book. So as we begin to wrap up, are there any other books that you have read that have made an impact on your career? And is there anything else you'd like to share with us today, Michael?
Yeah, I mean, look, I've met a lot of people in this industry, and I have a soft spot for the thinking of Nassim Taleb of the Black Swan. That I think is a writing that or book rather, and concept that resonates quite a bit to me, and makes a lot of sense because as Nassim I think has said correctly, history doesn't crawl, it jumps. And a lot of things in life are not driven by the day-to-day, but by these extremes, which are unpredictable, but often define, a future or a generation or a path in life. So I think the Black Swan and that sort of concept of the impact of, low probability, high impact events, not just in markets, but in life, is a philosophy that is always worth considering. And that sounds strange for somebody who's in the business of investing to say that because, this is an industry in investing where everyone has to make predictions and act accordingly. And those predictions are largely pointless if you have black swan events, right? So why even bother predicting? For me, it creates a mindset. I always tell people, I have no idea where the S&P 500 is going to be. I don't know what interest rates are going to do. I have no idea where oil is going to be. The only thing I can tell you about is the weather. I can tell you the conditions that favor an accident. I can tell you when to slow down. It's when I see a storm and I'm driving. I don't know where the black swan happens. I don't know where that mile marker hits where I might get into an accident. I just know I need to slow down in that sort of environment in the event that the black swan accident crash happens. Now, I may get to my destination slower, but at least I'm still alive getting to my destination. And I think, if you have that mindset, that helps you to figure out how to produce an asset allocation mix, figure out how to produce a portfolio that in periods that look stormy can at least protect you. And even if the accident doesn't happen, even if you're up less than the broader market or your benchmark, that's okay. You're living to fight another day. So I think Black Swan and that sort of mentality is a very important one for investors, and one that I think, unfortunately, people have forgotten about ever since '08. It seems that in today's world, central banks will do everything they can to kill off any kind of potential black swans before they happen. But the problem is you can't kill a black swan before it happens because that's the nature of a black swan. You don't know when it's going to happen. And I think that means anybody that's investing in markets has to always be mindful of not taking too much risk and not being too certain of an unknowable future.
Fantastic. Okay, well, many thanks for your time today, Michael. It's been great having you on the show.
I appreciate it. Thank you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?